Hello and welcome. You're watching Closing Trades here on ET Now. I'm Harsh Saita and let's look at how the markets are doing. 0.7% higher on the Nifty. We've built onto the gains that we've made today, but it's fairly range bound and it's an upward sloping graph and it looks beautiful on a day when we've seen more consolidation and in fact more building on all of the gains that we've made over the last couple of weeks. Again, when you're looking at the Bank Nifty, it's again supporting the Nifty 50 index. 0.6% higher on the Bank Nifty is where we are at. The IT index also fairly supportive, 0.5% higher. Mind you, slew of IT earnings over the next couple of days will continue to keep the IT index on our radar. So that one is something you want to take care of. But outside of that, metals is doing very, very well for itself, 1.3% higher. And PSU banks really are the place to be at this point, 1.5% higher on the PSU banking index. Within broader markets, it's the Nifty realty index, 3%. What a move. Very, very solid move on the Nifty realty pack. In terms of the broader markets, well, they're going from strength to strength. We're seeing a very, very decent run up in the broader markets as well. So the Nifty is largely mirroring the broader markets, but they're of course outperforming the Nifty as we speak, especially the mid-cap index in particular. The advanced decline, if we can pull that up, I'd reckon that the breadth is extremely favorable on a day like this. While it's not a day where we've made some huge moves, but just the stability of the move is what stands out in my opinion. There you go. That's the advanced decline showing you what the market currently looks like in terms of the breadth. Kunal, how are you viewing it?
I think it's a decent move for the markets, and especially given the kind of volatility which was seen yesterday for the indices. Today it's a different day altogether. It's like that the markets had forgotten yesterday very quickly, and that is a good sign for the markets to move on. I think I was also pointing out that yesterday at one point the premiums for the index futures had dropped down to 55 points, and today we swelled back again to an average of 105 points for the index futures. So that tells you that we are looking at an equilibrium point for the index at this 25,000 to 5,300 levels. Even if we just about consolidate over here plus minus 150 odd points, that will still be considered as a positive sign. And I think something like what you were highlighting, the fact that real estate stocks are making a comeback. You've seen the private sector banking names, the Bank Nifty making a comeback of sorts. I think when you have such kind of a strong sectoral breadth opening up, it's a very positive sign for the overall market. So net-net, the bias continues to remain bullish. Dips towards 25,000 should be bought into from a trading perspective. And on the upside, we will continue to look at 25,500 and higher targets for the index.
What's the sense on the IT pack now, Kunal? We've got, of course, half the IT basket which has come out with earnings now. What next? Are you seeing a bit of an up move possibility maybe in the coming week? Next couple of days, I understand may be choppy given that will continue to be, largely the impact of numbers which will keep coming out. But what about next week? What's the sense?
See, I think as a pattern, I'll probably look out for maybe a surprise in terms of news flow or events for the IT stocks. Because what happens is initially the first leg of up move for the IT stocks where the IT index moved from 33,800 to 35,500 mark in a matter of I think a couple of weeks. So which means a decent 4%, 5% rally for the IT index from the lows. Now we are heading to a zone where the IT index is consolidating. Now generally to come out of a consolidation for an underperforming sector, you would require a jolt of positive news flow happening for the sector or for maybe a few of the individual large cap components within the IT index. If that doesn't come across, then we may just expect that these sectors and the stocks may go into a drift where you might see maybe one of two stocks moving up higher and then the other dragging the index. So net-net, my belief is that if there is a positive news flow, I'm happy to buy the Nifty IT index on maybe a gap up or a sustaining of the gap. But I think that's the better trade rather than anticipating any kind of a breakout in the stock.
Well, Kunal, I'm going to pause the questions here, even though I'm really tempted to ask you more. There's just so many movers in the market today, but we have an hour and a half to cover that. So we'll come back to you on that. But Vijay Kumar, IAS Secretary, Ministry of Ports, Shipping and Waterways, had a conversation with us earlier today. Let's start off with the broader picture, sir. Street is very bullish on India's shipping sector and expects India's shipping and maritime sector to enter its golden era. The government has also announced a financial outlay of 70,000 crore for the maritime sector. How do you see this shaping India's port and shipping ecosystem? What are the immediate priorities?
Basically a four-pillared strategy. In the first pillar, we are looking at shipbuilding financial assistance. The idea is basically to cover the cost differential between the cost of constructing a ship in Indian shipyards and the cost of constructing a ship in foreign shipyards. So this scheme basically grants assistance ranging from 15% upwards, depending upon the type of the ship, depending upon the size of the ship, to shipyards who are constructing ship. So this will basically provide a level playing field between the Indian shipyards and the foreign shipyards. The second part of this scheme is basically the capacity to produce ships. So shipbuilding development assistance scheme, which is basically providing assistance for capacity building. It is again has got three components. In the first component, we are looking at expansion in the brownfield capacity of existing ports. Second component relates to setting up of greenfield capacity. And we are also looking at setting up an Indian National Ship Technology Center under the Indian Maritime University, which will become a leading center of excellence in ship designing and ship construction. And as a part of the shipbuilding financial assistance, we are also looking at incentivizing the recycling of ships in India. So a credit note to the extent of 5% of the scrap value of a ship will be provided if a ship is recycled in India. And this credit note can be used against shipbuilding in a domestic shipyard. So this will achieve basically two objectives. We promote recycling within India, and we also promote our domestic shipbuilding. And both these schemes will be supervised by a national shipbuilding mission, which is being set up shortly, maybe within a week, which will also have an advisory board, which will comprise of industry groups, stakeholders, academia, so that the scheme is implemented in close coordination with all the stakeholders.
Right, and so is the intent of these funds to primarily move or improve infrastructure, ports, shipyards, logistics, or to provide financing support to the industry? What is that balance that you are likely to strike? What's the final objective you're working towards? Give us that sense.
First of all, the entire package is about 70,000 crores, all the components included. And as the basic objective is to create a complete ecosystem for increasing domestic shipbuilding orders, and also to increase the capacity of our domestic shipbuilding industry. It also has components for port modernization, shipyard modernization. So taken together, this will be looking at the entire ecosystem.
And one of the biggest challenges has been the high cost of vessel acquisition and operations in India compared to that globally. How do you plan to bridge this?
So basically, if you look at domestic shipbuilding, the assistance will come from Shipbuilding Financial Assistance Program. If you are looking at ship acquisition, not really construction within the country, then one can take assistance from Maritime Development Fund, where the government is already coming up with an equity contribution.
Right, and what kind of private sector participation are you expecting in this maritime push? You've obviously had conversations. Have any large players already shown an interest?
There has been a lot of interest from private shipbuilders, from shipping companies, domestically as well as from all over the world. And we have had a number of stakeholder meetings. In fact, the entire maritime sector all over the world is eagerly awaiting the implementation of these schemes, and orders have already started coming in. Recently, about a day back, one of the biggest shipping companies in the world has placed an order for supply of 6 container ships on Cochin Shipyard Limited. This is the first time in the history that a container ship order has been placed on a domestic shipyard. And this is basically linked to these schemes only. So we are getting a lot of queries, lot of requests, lot of discussions are in offing with the domestic players, with private players all over the world, and a lot of big international shipping companies, international ship owners are coming in. There's a lot of buzz in the industry about, there's a lot of excitement.
Okay, and how is the government looking at developing a ship repair and maintenance ecosystem? How are you planning to promote the business opportunity in India that this could offer?
Another part of this whole ecosystem is how to create a very strong ship repair industry in the country. So already two ship repair clusters we are working at. One is in Kochi, Kerala, and one is in Vadinar, Gujarat. They are also part of our Maritime India Vision 2030 and Maritime America Vision 2047. The aim is basically to get international clients, boost our ship repair volumes, and enhance profitability of the MRO segment. In fact, already an international ship repair facility has been developed in Cochin by Kochi Shipyard Limited, which has got, I think, India's biggest ship-lifting crane. And Kochi Shipyard is already talking with one of the biggest players, or one of the biggest global players, one of the biggest global players in the MRO sector. The talks are at a fairly advanced stage, and soon we expect that JV to be formed and the further expansion of the capacity. Similarly, in Vadinar, Gujarat, Kochi Shipyard is already working with the Deen Dayal port to develop a ship repair cluster there. So there is a lot of potential there, a lot of things are happening, and soon you will see a spurt in the MRO business in the shipping sector.
Okay, and barring the financial outlays, that the government has already announced, will the government consider incentives or subsidies to encourage domestic ship acquisition as well as fleet expansion?
If you look at all the packages that government has already announced, they address the supply side of the shipbuilding part. That is basically bridging the cost differential, increasing the capacity of the shipyards. The other part that government is looking at is basically how to increase the domestic demand. So we are working at what we call demand aggregation. We are in talks with the major cargo movers of the country. In fact, a lot of talks have already taken place. A joint task force is working on that under the guidance of the highest offices of the country. And where the aim is that the entire cargo demand in terms of what number of vessels that we require over a 10-year period or so is aggregated, and that demand is placed on domestic shipyards. So that will stimulate the domestic demand side of the shipping industry. So taken together, the supply side is addressed by the financial packages. The demand side will be addressed by the demand side aggregation. These two will complete the entire ecosystem.
Okay. Thank you so much, sir, for coming in, giving us that perspective. Absolute pleasure to have you here on ET Now. And viewers, with that, what we'll do is we'll slip into a very short break. Stay with us. More on the other side. We'll start taking individual names and we'll have a very interesting conversation which we've lined up for you.
Back with closing trades right here on ET Now. Let's try and deconstruct what the market has been like from last Diwali to now and what it's going to be like as we step into somewhat 2082. We've got Nimesh Chandan, CIO at Bajaj Finserv Asset Management, joining in on the show right now. Nimesh, hi. Thanks for making it to the studios, and festival greetings firstly to you and your entire team.
Pleasure to be here, and festive greetings to you and your team.
Okay. Is it really going to be as sparkly and as bright a Diwali as one anticipates? Because last year has been nothing really.
I think last year was a bit tough, and we saw multiple issues in terms of geopolitics coming up, multiple tweets disturbing us overnight. So I think this year looks like we are set for a strong up move. I think markets are like a coiled spring, and we'll go through this process of de-verification, as I call it, that there were so many worries which were putting pressure on valuations, and now one by one we are getting these solved. So even if you don't see much change in the Nifty estimates in terms of earnings, you will see a sharp increase in valuation. So I think we are set for that kind of a move in terms of re-rating upwards or coming back to our high valuations.
But isn't the critical thing for the earnings to come back? When do you foresee that happen?
So surprisingly, some of the major events that we were worried about have hardly had any impact on Nifty earnings. So if you see the Trump tariff issues, 0.3 to 0.5% of GDP was getting impacted. It is impacted right now because of the penalties, and about 2% of the Nifty 500 or NSE 500 profits were getting affected. There was not much change. In fact, government has given a stimulus which is equal to 2% of the GDP, and that will probably see the second half, consumption doing well and also capex coming back. So Nifty earnings were not affected, but it's typical nature of the crowd behavior that when you are uncertain and fearful, if you don't change your EPS estimates or PAT estimates, you actually reduce your multiple. just to accommodate some of the worries that you see on the horizon. So if these worries get cleared, automatically you see the converse of that happening, where you will see the re-rating upward without changing much the EPS number.
And Nimesh, of course, so therefore the Nifty EPS growth over the last 12 months has been single digit. And that is, if I can call it, a possible concern. Do you expect that to likely go up? Because, of course, top line growth may be supportive to a certain extent, but that is also yet to be fully felt where the numbers are concerned. When does that happen, if that is so?
So I think we've been through the worst. So I would say if last year the FY25 Nifty earnings grew at about 6.5 or 6.8%, that is Nifty at its worst. It saw so many issues last year in terms of, we had a very slow GDP growth in the first half. Yes. We saw some liquidity issues, rupee having a struggle in the third quarter of last year. So we saw tight liquidity, we saw tight business conditions and slow growth, and yet Nifty, because of its very diverse sector base that is contributing to earnings, we saw 6.8. This year we are likely to see just move towards a high double digit, just move towards a double digit. So you will see about 9% or so kind of earnings growth. Next year you move into, say, 12 to 13%, although the estimates are about 15%, you see about 12, 13% can be done. Look at the trajectory, 6.8, 9, 12 to 14. You are actually seeing a strong recovery. And India's strength has been this diverse earning base, so many sectors contributing. Yeah, there'll be years where probably IT may not do so well, there'll be years where banking may not do so well. But this stability and steady earnings growth actually what gets Nifty its high multiple in the market. We are not so commodity driven, or we are not so volatile. I think when people recognize this, that India is one country where you can stretch this 6.5% GDP growth rate till 2030, which is very rare to see in other countries. And if earnings are going at, say, 10 to 12% even for the next 5 years, you have a very steady growth in Nifty, just even if the valuations don't change.
Let me take a cue from that. Which sectors, therefore, do you believe will benefit the most and will in fact benefit upfront from all of the measures that have been taken? The lowest hanging fruit, if I can call it.
Consumption is a very easy pick here.
Okay.
Because we have just seen a pickup in consumption. Last 2 years, most of the market was focused on the capex side, mainly on, say, defense side or certain specialized manufacturing side or so. We will see now attention going towards consumption. These are brilliant quality companies. They deserve a higher valuation because they are branded businesses, they have more steady growth, they have cash flows. Many of them are at very good dividend yields. Last 2 years, these guys have been going through a slowdown. Now you will see an earnings upgrade as well as a valuation upgrade. And the India consumption story is a 5 to 10 year story. It is not a short-term story. So you will see this large pool of subsectors starting to do well, whether it is consumer discretionary, staples, quick commerce, digital consumption companies, travel, QSRs, you name it. So there is a huge amount of scope for many of them to grow. You have to just pick up which are the right companies, which have the right moats and the right cash flows and the right valuation.
Well, where do you see the profit pool getting created?
So much of the consumption story, if I put it, is about unorganized to organized, and within organized, premiumization. So if you take these two trends, companies and brands that are able to give their customers an option to move from unorganized to their brands and then scale them up within their brands. Think of the auto sector, right? You saw a move from two-wheelers to four-wheelers. Four-wheelers, now SUVs are a large part of their allocation or of the consumption. Look at companies like, I'm just using a name, Mahindra and Mahindra, which has a beautiful portfolio of SUVs, how it has done, despite when overall consumption was going a little slow. There are many companies within FMCG, QSRs or so, where we are moving from unorganized to organized. And that trend is irreversible. So people aspire to have brands, aspire to move up and premiumize. So you have to pick up these companies which allow or have a portfolio which allows you to move up there. we are positive on some of the high growth sectors within consumption, like consumer discretionary, home improvements is coming back in a big way. You saw some of the recent listings. People are seeing very strong move in white goods, and that's why you're seeing premiums coming to these companies which are also getting listed. So there is whole bunch to play. Yeah, we look at some of these mega trends within consumption, that unorganized to organized, so where people are consuming more, consuming better, consuming easier through financing, digital commerce, those areas which we find as high growth potential areas, and we are bullish on those.
But have all of these pockets got valuation comfort? Because every time we speak consumption and we speak with anyone who seems to be a sort of a pessimist in investing in consumption, always the reason that comes up is some of the valuations are extremely elevated. Do you find that there are currently pockets of value which may not be as elevated, which may be reasonably priced, and yet provide that margin of comfort in terms of making an investment at this point?
So because last few years I'm seeing the crowd becoming very short term, there is a very strong recency bias in the crowd. So right now, anybody who you speak to about consumption will first ask, is this company a GST cut beneficiary, or it is not seeing a benefit of GST cut? Now, that is a very narrow way of looking at it. And frankly, some of the, say, auto was an obvious gainer in GST cuts, and you saw auto stocks just move up very swiftly. And they were under-owned. The full year growth for passenger vehicles was not much. It was very low, single digit. Now it's been revised upward. So you saw a very sharp move in auto first because of the GST benefit. Now, if you take into account the total impact, the wealth effect in households because of gold, the income effect because of the income tax rates that are cut, there is another trigger which is coming for urban consumption, which is the 8th pay commission changes. Rural is continuously doing well. So I would say, because people have this recency bias, there are certain sectors, certain stocks have become expensive, and we are also a bit, because they are touching the bull case scenario for us, we are also not so excited about those. But if you dive down, there are within large caps, mid caps, small caps, there are many spaces. And you can play some ancillary plays also, right? NBFCs, which are, say, financing consumption, autos or so, they have important. Today we are seeing insurance companies that are benefiting from auto sales or consumption increasing. Those are starting to do well. So if you actually unpack this theme and not look at consumption as one sector, but unpack it as a theme or a mega trend, then there are many, many areas you can go for.
And what about consumer tech?
Absolutely. So these are companies which are increasing their market share, and they see visibility and scalability of growth for many years to come. Now, again, they went through one hype curve when they got listed at very high levels, and then went through a trough because there were disappointments, and now they are actually coming back. And here the men are separating from the boys. Companies that have a strong business model are able to monetize these trends, which means your customer is allowing you to make some profit or EBITDA from these businesses. And for many of them, the investment phase is getting over. It's now time to reap the returns. For many of those, you will find that the crowd is ready to pay high for that scalability, for that growth. So those also, we are very positive on these digital tech companies or some of the new age companies that are there. And so whether it is, I'm not naming, but there are many of them, like, quick commerce companies, and many of them which have been recently listed. Those are positive companies that we play for. And consumption has its impact on the economy. Consumption will ultimately lead to private capex coming up, because you will see capacity utilizations moving up.
Yeah, you saw that with Maruti.
Businesses looking to invest more on that.
True. So that's, of course, the consumption end. But what about the traditional businesses? What about commodities? What about IT?
So we have a strong contrarian buy call on commodities, which are metals and
Which is
real
done well.
estate. So those two, we have a strong buy, because we believe that these companies are undervalued. They are trading at replacement cost or below their NAVs or whatever metrics that you use for measuring them. And we are seeing an upturn globally in emerging markets. you will now see last 10 years, emerging markets have not done so well. Now, because of less pressure from the dollar side and interest rates being low in the US or being cut in the US, you are seeing change in emerging markets. So those countries are doing counter-cyclical investments to boost their own domestic growth. That typically leads to better consumption in terms of metals, demand for metals going up. And over the years, the cost of mining, cost of sustainably mining is going up. So many of these metal stocks you will see, and silver is just a glimpse of it. It is a combination of precious metal and industrial usage. But you will see steel, copper, aluminium, zinc, all now showing some kind of an uptrend. It's difficult to predict metal prices very accurately, but you can definitely say when they are cheap, and you can take a bet on those. And many of these metal companies, see, last 10 years, these metal companies have also cleaned their balance sheet. Many of them are dividend yield plays.
Yeah.
They are not doing capex at the wrong time and then getting stuck with huge debt on the balance sheet. They've changed that also. Real estate also, if you see, the balance sheets have been cleaned. And we are seeing a good pickup in Diwali. There are many launches planned for Diwali. And real estate, when it grows, it again has a multiplier effect on the economy. You have, it is a very labor-intensive sector. Cement, steel, white goods, tiles, faucets, wires and cables, paints, everything starts getting improvement. So you will see in the ecosystem, the home improvement ecosystem also starting to do well after many years in this. And because once these companies used to be trading at very high multiples because of their brands and sustainable growth, now they are available cheap. And that's where we are bullish that some of these ancillary plays also become very good attractive opportunities to pick up.
Welcome back, and we're live from the SBI Live studio. We're bringing you closing trades here on ET Now. Let's go across. Have a quick check on the Nifty 50. It's up around 0.4% thereabouts. So we continue to consolidate at that level over the last hour or so of trade. Nothing much in that sense, but when you're looking at the breadth, it's extremely favorable. 41 advances to just about 9 declines on the Nifty 50 index. That just signifies the strength that the index is showing at this point. The Nifty Bank also doing fairly well for itself, 0.6% odd higher, so that one also doing fairly well. Auto is perked up decently well in trade. The IT index also supporting extremely well, but it's the Nifty Metal which is standing out, 1.1% higher. And Kunal, we were just chatting about the Nifty Metal. Where to from here? 1% higher again, and it's had a phenomenal FY26, the Nifty Metal in particular. Where to from here?
See, look at it this way, that 2024, the metal index was almost at 10,200 thereabouts. Yes. We are back at 10,200 levels, but most of the components are not. Like Tata Steel is still, I think, around 10%, 15% lower than the previous highs. SAIL is, I think, far below its lifetime high levels. And then you have very few components like JSPL or Hindalco which have done reasonably well. Vedanta is also, I think, 10%, 15% lower than the previous highs in 2024. So that tells you that when the index has started to move up higher, many of the stocks are still lagging behind. But I have historically seen that whenever metals as an asset class, when they start to move up higher, it generally results into a multi-year breakout for many of the metal stocks. So I think in that sense, I would probably expect many of these names to perform very well for themselves over the next 1 to 3 years or so. I think Tata Steel, the previous highs was around 185 or 190 thereabouts. I sense that that breakout could happen for the stock in the next 1 to 3 months. SAIL, I believe, closer to 145 to 150 could be a big breakout point for the stock in the near to medium term, and so on and so forth for many of the other names.
You know, what Nimesh was saying, that there is one, of course, that secular move which is at play in metal names. And then one way of looking at it is also that they're dividend yielding stocks. So Kunal, what about a Vedanta on the charts, for instance?
Yeah, so I think Vedanta has been an odd man out, frankly, Aisha, because, the stock has underperformed in a phase even in 2024 when, metal stocks were going in their prime. Recently, Vedanta, I think after the spate of positive news flow, has managed to make a comeback above 460 mark. But the only, I would say a statistical behavioral point for Vedanta is that the stock is very erratic. We've seen the stock going into, stable trends of on the upside, but then all of a sudden you see a negative news flow and the stock drops by 10-15% in just a matter of few days and weeks. That makes long-term traders or maybe investors to buy into the stock a little bit, on the edge. So that I believe is the only concerning point for a stock like Vedanta. Otherwise, as I said, that it's the entire rally for the metal stocks which is due on a multi-year basis, and there has to be a point where Vedanta will also participate.
Okay, Kunal, keen to know your view with regard to an Axis Bank. This is one which has moved 11% in the last 5 weeks, significantly outperforming the Nifty bank index as well as the Nifty 50, both year to date, if I look at just these last 5 weeks, as well as over the last 12 months, 11% returns on an Axis Bank. Of course, results today evening, and we will be tracking that closely. But give us a chart check on this one.
See, I think, again, I'll agree that I think Axis Bank was one of the better performing private sector banking names at a point when the PSU banking stocks were doing well. That was around a month back, September, start for the entire, banking index where you saw the rally coming by. I think from a base of 1,050 thereabouts, Axis Bank moved towards 1,200 levels, so a decent 15% upside. Now, in the last 1 week, the stock has seen a mild correction. But the tendency of the stock I've seen in the last 1.5 odd month is to just try and cling on to its 20-day moving average. That's a mean reversion point where after a decent rally, the stock just consolidates, reverses back towards its 20 DMA. And then from there, you see a resumption of the rally. The stock has come back to that 20-day moving average level as we are speaking right now. So I would believe that it's a good level to go for a contra buy on Axis Bank. I'm not sure the results, etc., how the stock would plan out, but purely in terms of the charts, I think at 1160 thereabouts, it's a good trade or a good risk reward to go for a buy with a target of 1200 to 1220 at least.
Okay, so that's the take with regard to an Axis Bank. Now, talking results itself, you're expecting margins to continue to be under some bit of pressure. Mind you, Axis Bank has guided for across the cycle margin of 3.8%. They've done that in Q1 FY26. You're likely to see some bit of more pressure creep in with regard to where that margin number is concerned. The quantum of margin recovery and any guidance on that count will be keenly watched by the street. So that's with regard to margins. Moving on in terms of growth. Now, we've seen some of the larger private sector banks do 4% sequential, and I'm talking about both HDFC and Kotak. HDFC, of course, on a far higher base, but Kotak obviously is around half the book size in terms of when I'm comparing to an Axis. What you'd want to see is whether Axis can pick up and push that growth pedal, if at all. So that's the number we'll wait out for. Cost ratios. This has been a concern for Axis. They've missed their OPEX to assets or cost to income ratio, as you would call it. They've missed those guidances. Whether they can stick to it, whether they can play the operating efficiency, and therefore whether operating profit can also be strong enough or not is something that we'd have to watch out for. Credit costs. Now, it's been a tough environment where Q1 is concerned. Credit costs expected, hopefully Q2 to be better, but we'll have to wait and watch. And any guidance with regard to full year in terms of credit cost is the other piece that we'd want to know. And asset quality, especially given ECL as well coming through, how much of that is already penciled in, how much of that is not, is something that we'd have to wait and watch out for. So those are some of the factors with regard to where an Axis in Q2 we'll look out for, and we'll know that first thing tomorrow morning before open. We'll sit out and discuss some of those factors and how that will play out.
Oh, yeah. In fact, it's going to be a spree of those private banking names, right? Then over the weekend, you've got ICICI Bank and HDFC Bank as well. Who do you think is going to be the best performer of the lot?
Oh, that's a very, very tough one. But my sense is Kotak has already surprised with regard to growth, and so has HDFC. So you might see some of the private sector banking players do much better. And Kotak and HDFC have been laggards over the medium term as well. So my sense is that maybe those two might surprise where earnings are concerned as well.
Okay, lots of banks up ahead and a lot of earnings reactions as well coming in the pipeline. We'll take a very quick break on that note. Come right back. Back with closing trades, and we're coming to you live from the SBI Live studios. Holding out well, actually, for the equity markets. I don't know whether this is a decisive break or not, but we've managed to eke out about almost 220 points now up in the green for the Nifty futures. So going well. It's realty, telecom, finance. That's the pocket of the contributors list in the markets right now. And a good day for the market breadth as well. Persistent, of course, is reacting to its numbers. But look at an EU bank, look at a Prestige, ICICI GI, or for that matter, Nestle. In fact, you're seeing gains of anywhere between about 4% for a Nestle to ICICI GI, which is perked up over 8% as we speak. Tata Motors, Policy Bazaar, Delivery, OFSS, ICICI Pru Life, that's where you're seeing some dots of red still. But Ashi Anand too joins in on the show right now, founder and CEO at IME Capital. Ashi, hi, afternoon. Ashi, pretty lackluster the past 1 year. How do you think the year ahead is going to pan out? And do you sense that there could be an earnings recovery and a meaningful of that at that in any of the sectors this earnings season?
Sure. Firstly, thanks so much for having me on the show, and early happy Diwali to all the viewers and to all of you at the studio. Um, yes, it has been a fairly lackluster year for the past year, and the reasons are quite clear. Growth has come down. There has been a lot of increased kind of uncertainty around what's happening around global trade, what Trump is going to do, etc. Our core view is that you're kind of likely to remain range bound until you start getting some clarity on these two core elements. One, the growth recovery and the growth rebound. We are going to be kind of very closely watching this kind of Q2 earnings season because a lot of people have a hope or a belief that you will see a recovery in the second half. We kind of watch corporate commentary very closely to kind of see how clear is that just general optimism or are there clear signs for that? You already had a few IT company results come out. They have been slightly better than expected. So I think this earnings season is going to be very important to kind of lay the foundation for market performance going forward. You also very, very clearly need some kind of clarity on what's happening on global trade. The US-India trade deal has been kind of is long waited. We still don't have any clarity on that. I think until you don't have these two core headwinds kind of being taken away, you are likely to see kind of markets a bit range bound. It's also probably good at some level because after COVID, you've kind of seen a strong one-way movement to the markets, and you did need a certain amount of time for kind of valuations to correct. So our kind of view is if you're kind of looking forward for the next 1 year, we probably expect the next quarter to 6 months possibly to be a bit more range bound. But as you start getting clarity on these two core elements, we kind of believe you're laying the foundation for the next big move. And that's really what we're kind of waiting for.
And what's the best risk reward in this market, Ashi? Hi, this is Harsha. Good afternoon.
Harsha, hi. So I think, and we've been very clear on this. So I think the last couple of years, we are huge bulls on the whole digital ecosystem or digital disruption. So digitally native platform businesses, the like of an Eternal, the Swiggies, Paytms, PhonePe to be listed. This entire space, you are seeing a tremendous amount of value migration happening away from traditional businesses towards the space. We believe that very strong growth rates can continue well into the decade. And we're also very optimistic about the profitability of these business models as they kind of reach a stage of maturity. A combination of this very strong growth and a shift towards profitability, according to us, makes this hands down, at least for us, the theme to bet on over the kind of current decade. So at this current point in time, especially from investors with a longer term investment horizon, we keep believing that digital ecosystems is very, very attractive. I think from a slightly more shorter term perspective, we kind of seeing quite a lot of interesting value and also a bit of a growth recovery in both the banking space as well as consumer names.
Okay, and what do you avoid, Ashi, in a market like this where we've been sideways for a really long time, but yet valuations still don't look altogether comforting?
So I think the important areas to avoid, right? And a lot of people have been talking about a certain level of froth in small caps for the past year and a half. There are certain segments within this which may be a bit more frothy. I think you want to, especially in this kind of a market, stay away from anything which had moved very substantially over the last 2 or 3 years, where valuations are not very comforting. Large parts of the small cap space do actually hold there. The other core element is that any kind of company or sector where there is a large amount of dependence on US kind of as a market, I think this needs to be watched kind of a bit carefully because Trump is just a very difficult animal to predict. So far, we have had the negative impact in terms of manufacturing. At least it doesn't seem like this is going to move too significantly into pharma generic exports. He's already impose some tariffs on kind of specialty exports. But I think pharma, generic exports, IT services, some of these you just need to be a little watchful. But I think the place to kind of clearly avoid is probably overheated small caps, especially companies which aren't as well known without too much of a trading history, etc.
You have HDFC AMC's numbers flashing on your screen, viewers. That's, of course, for perspective. 16% higher on the revenue front where HDFC AMC is concerned. EBITDA up around 14 odd percent. Stock perked up 1.5% in trade as we speak. And, of course, as we go by through this week, we'll start to see more and more earnings dominate, this time slot of our show. So you want to stay tuned and you want to stay on top of it. Net profit up 25% on a YOY basis for an HDFC AMC. Ashi, capital market plays, is that something that enthuses you? Does it excite you? Is it a longer term theme? And again, how does the risk reward, or what's the kind of margin of safety that you're seeing on some of these counters?
So I think capital markets is a very, very interesting longer term theme. It is something where we have a pretty decent level of exposure in our underlying portfolios as well, which reflects our kind of underlying view. India is still at very early stages of this probably multi-decadal financialization of savings theme. You have a significant amount of Indian wealth which is still stuck in bank fixed deposits, real estate, and gold. All of these can move towards financial markets. Now, this could happen via mutual funds, it could happen via insurance, it could happen via direct equities. There are multiple elements, but there is a large value migration theme which is clearly at play here. We believe this is not just a 5-year, 3 or 5-year play, but it's kind of a 10, 20, it's a much longer term theme. Being capital markets is obviously going to be cyclicality in the nearer term, but I think from a longer term perspective, this looks exceedingly attractive. That said, I think when you're looking at capital markets, you really need to be looking at the sub-segments within capital markets because there are quite important kind of underlying trends happening in different segments. So asset management companies, right, and HDFC AMC just came out with the numbers and you can see they're quite positive. I think this is a theme which is looking really quite promising to us. Insurance as a space has underperformed over the last some amount of time. We find valuations quite attractive and the long-term growth trajectory is very clear. Your brokers are someone we're a little cautious about because SEBI is really cracking down quite significantly on the overall kind of F&O volumes. The longer-term impact of this, whether kind of business models or economics will need to be modified around, is still not very clear. We'd rather see some clarity before going aggressive on kind of brokerages. And I think wealth management is seeing some level of yield pressure or supply side kind of pressure around private bankers and their costs moving up, etc. So I think while capital markets as an overall theme is clearly very attractive from a longer term perspective, you do probably need to be a bit selective in terms of which segments within capital markets that you're focusing on.
Right. Okay, Ashi, great to have you on the show. Thank you so much for taking the time out and speaking with us today, and wish you and your entire team a very happy Diwali from all of us.
Thanks a lot.
Okay, let's just take stock of what the market is settling in at, and it's good going. We've been flagging off some of the key winners today. The breadth of the market is looking very smart indeed. Persistent, of course, is up there. Prestige has made a very smart move. So all those stocks looking good. AU Bank is up higher by about almost 4.5%. And ICICI GI, we're just seeing a solid 8.5% move, no less. Within the large caps, it's Nestle all the way. It's perked up a solid 4% right now. Bajaj Finance has been a very strong show. Asian Paints has jumped up 3%. L&T looking also very smart. And as is the case with Interglobe Aviation as well as Geo Financials, they're all names which are going very strong indeed. But in an exclusive interaction with ET Now, we had the CEO of Etihad Airways, and he told my colleague Samir Dikshit that Etihad Airways is focused on buying new planes and is looking at big opportunity for itself in the Indian aviation market. Let's hear out a slice of that exclusive interaction.
We actually have already the orders that we need to do that. Okay. So, I mean, we're constantly ordering planes. So, for instance, last week we bought 4 planes in the secondary market. So, buying planes for us is something that we do as we go. Okay. We don't do these big orders of 200 planes, 100 planes, because we prefer to be a bit more opportunistic. Nothing wrong with the strategy of buying 100 planes, 200 planes. Some airlines do it very well. We choose a different path, right? We buy as we go and as we see the strategy evolving, because we believe that it's important to leave fleet flexibility on the table, because you never know what's going to happen in the future.
Mr. Nifty, at this point, would also like to understand, since you mentioned that how Abu Dhabi has become a very strong international hub, but now Indian government is also looking to set up a global hub, aviation hub here in India, the upcoming Navi Mumbai airport, the upcoming Noida International Airport, and also the way domestic carriers, they are placing big aircraft orders. Do you see it as a major challenge for the international airlines who come to India, and how you overall analyze it?
Indians are very humble, right? You already have a mega hub here. You have mega airlines. I mean, I am a big admirer of the airlines in India. Look what's going on with Akasa, a brand new airline that is thriving. Indigo is one of the most valuable airlines in the world. Their profits are extraordinary, make a lot of money, right? So India has a thriving airline industry. I mean, it's, again, I go back to the start of our conversation, right? 15 years ago, Brazil had 80, 90 million passengers. India had 80, 90 million passengers. Now you have 250 plus million passengers per year. So it's booming. It's really booming. It's already there. And I think what India is doing is the right thing. India is investing more in infrastructure. The Indian airlines, they see that an opportunity, they're investing. So I think the future is really bright for the Indian aviation sector. That requires, of course, working together with other airlines from abroad. You cannot do anything alone in this world, right? It's really interconnected. So I see only opportunity for us to be here working with India to deliver what is best for the customer. And if you see what's going on, more than 2/3 of the traffic growth in India, international, today is done by Indian carriers. More than 2/3. We're only 10% of the growth that you had. Okay. Right? And many other airlines are not even growing anymore in India, so it's already happening.
Welcome back. You're watching Closing Trades, and we're live from the SBI Live studio. Thanks for staying with us. Some big movers today, and just speaking about that, 8% higher on ICICI Lombard. Bank of Maharashtra now perked up 7.7%, 7% on a persistent. These are in no way small names. These are large market cap companies now. Okay, they may not be large caps, but they have fairly significant market caps. But the move today has been fantastic on some of these names. Real estate plays, a Godrej Properties for one, a Kolte Patil is the other one, which is doing very well. Keystone Realty, of course not within the Nifty Realty pack, but is down 7%. That OFS keeping a lid with regard to how that stock is responding. Let me go across. Kunal, give us your view. This 7% move on persistent. It looks interesting. Give us your sense on what this means in terms of a move, and does it completely change the levels of a persistent that you would be looking at today morning versus post the move?
Well, absolutely, yes. In fact, what this move does is it catapults the mid-cap IT stocks into slight high confidence zone, something which was missing for the IT names. The best part is today's volume is almost 32 lakhs for persistent, which is almost, I think if I'm not wrong, 6 times or 7 times the average for the last 2 months for the stock price. So that itself tells you that it's not just a price up move of 7-8% for the stock price, but it's the participation which has been almost 6 times odd higher for the stock over the last 2 months of average. And this also gets the stock into a breakout mode. And when you see the last 2 months of chart patterns, 2 months back the stock was almost at the same levels of 5,600 to 800 range, and now it's come back to that kind of a trading range. So when you look at this in the manner of the last 2 months of price action, it says that the stock has negated all the negative price action built into the stock price over the last couple of months, and now trying to reverse itself. That I believe could be a good start. So what matters over here is time frame. If someone is looking at maybe another couple of days perspective, then I don't see any major uptick coming back into the stock price, because now at such kind of a strong volumes, you expect the stocks to digest this kind of an up move. But then if your time frame is another 3 months and more, then I believe at current levels, buying persistent at the current juncture could also turn out to be a good bet.
Okay, so that's with regard to a persistent. Let's go across, listening to what the management had to say with regard to the numbers.
See, first of all, the 2 billion is something that has been one of the reason why it gives us a confidence is that this is now a 22nd consecutive quarter whereby we have shown growth. If you look at our growth for the last couple of years, it has been in a compounded annual growth rate of around 24-25%. So if you look at, if we continue to look at the delivery on the same basis, we should definitely be looking at achieving our 2 billion target by FY27. As far as the 5 billion target by FY31 is concerned, we had said that this will basically be on 2 or 3 pillars. The first one, if you look at we work and operate in 3 segments: banking, financial services, insurance, then healthcare, life sciences, and then high-tech communications, media technology. Now, if you look at these sectors per se, they are oceans. These are not one vertical per se. Within banking, you have banking, capital markets, financial services companies, insurance companies, broking companies. In healthcare, life sciences, we operate in scientific instrument, medical devices, payer, pharmaceutical companies. So that's for the subsegment. In the healthcare, you have communications, media, hyperscalers, hardware, software, SaaS players, fintech companies. So these are quite a bunch of resources. So what we have basically said is these segments we'll now looking at sort of dissecting down and focusing on growth of these subsegments. All these subsegments put together should contribute to the overall growth of some of these verticals.
Okay, that's that on persistent, and now all eyes are going to be on Infosys. So let me take it across to Mansi and find out what is it that we
concerns in the overall setup. The higher S&M investment, legal professional costs are some of the concerns which will trigger the results for that matter. Talking about the tailwinds, the positives, rupee depreciation and operational efficiencies which we have seen in the company and the development of the company and in the operations of the company will act as the tailwinds in particular. Guidance, we are expecting the revenue growth to be in the range of 1 to 3% on a year-on-year basis, and also if we talk about the margins, 20 to 22% is what is expected. Note the guidance excludes the Versant Group acquisition impact, so that is an important note. In the guidance which we are talking about, it excludes the Versant Group acquisition impact. Lastly, talking about the key monitorables which one needs to watch out for, the discretionary spending outlook, H1B visa impact, Gen AI deal win and revenue productivity impact. All the IT companies are now talking about artificial intelligence and developing their workforce in the AI category. The vertical performance, deal TCVs and pipeline and pricing trends. These are all the key monitorables which we need to watch out for when the Infosys numbers will come in. All in all, we expect stable margins, revenue to drive growth, and at the same time, the profit will also see an uptick of around 4%.
Thank you so much for that, Mansi. Now, of course, Infosys will be in focus, but it's also LTIMindtree, likely to post a 4% QOQ revenue growth in the second quarter, with growth largely led by retail, travel, manufacturing. The Street eyes CEO Venu Lambu's strategic roadmap, deal ramp-ups and margin sustainability, all three. Mansi, what can you tell us about this? What should one watch out for?
The quarterly earnings of LTIMindtree, our expectation is to see a constant currency revenue growth of around 2.1% on a quarter-on-quarter basis, driven by a ramp-up of large deals. We also expect retail, travel, manufacturing and healthcare verticals to be the growth leaders, the growth drivers. Margin expansion is expected on operational efficiency, growth leverage and rupee tailwind. So these are a few positives which one needs to consider, which will help the margin. However, our expectation are for the margins to be in the range of 14 to 15%. So that's what we expect. Talking about the constant currency growth, it will be aided by ramp up of agri deal, top account pass-through behind and cross-currency gains. And a few watch points which we need to consider are the progress on CEO Venu Lambu's strategic initiative. Last year, the management took Venu Lambu as the CEO of the company, and now what are the forward-looking strategies he has for the company is what we need to watch out for. H1B visa fee impact, demand outlook in BFSI segment, particularly manufacturing and high-tech segment, the deal ramp-up visibility, and margin sustainability ahead. So these are the key watch points, monitorables which we will consider. However, talking about the numbers, we expect good set in terms of revenue, EBIT, margin as well as profit figures.
Right, and Mansi, slew of earnings, so tell us what to expect from Wipro as well.
IT major Wipro is slated to post its quarterly numbers, and if we talk about the parameters which we are considering, we expect flattish constant currency revenue on a quarter-on-quarter basis within guidance range of 1% at least. The BFSI vertical will drive growth. We do see that in all the IT segment company results, the BFSI vertical which is performing really better, and the same will be the case in case of Wipro as well. Weakness will be seen in manufacturing, retail, CPG and logistics segments. Margins are likely to stay in a tight range due to upfront requirements in large deal ramp-ups and the few concerns which we did see. Margins in a way will see a softening, a slight softening or see a bit of an uptick. We are expecting it to be in the range of 16 to 17% due to muted top line and large deal ramp-up cost as we speak. The second half is expected to outperform the first half, supported by strong deal closures in the first quarter. So that's something we need to watch out for. Key watch points which we are considering, the monitorables are the quarter 3 guidance tone and large deal execution, what the management is talking about, the forward-looking approaches, execution on ramp-up, H1B visa fee impact, consulting demand outlook, deal to revenue conversion visibility, margin and vertical commentary. A very important and critical observation is that all of the IT companies are now talking about artificial intelligence, and clients prioritize AI data and modernization programs, seeing a clear trend of many AI projects moving to scale and production. So clearly some announcement is expected here as well in terms of AI and going ahead in the artificial intelligence and that space in particular. So all in all, we expect the revenue to see an uptick. The EBIT will also see an upsurge. Margins will stay intact in 16 to 17% levels. However, we might see a downtrend in the profit front.
Okay, enough done on IT. Thank you, Mansi. We'll let you go on that note. Kunal, with regard to an HDFC Life, that one is perked up 2.5% in trade. Again, and fairly steady. Again, on numbers, this one will be in focus. Trying to understand how this one's looking after the move today.
So the risk reward is little attractive for HDFC Life. The stock has retested the lows which it did in the month of July, August, when it has come back to that 740-50 zone. But then the concern for HDFC Life is the typical or the usual low beta of the stock price, and that puts the hindrance into stock price rallies for HDFC Life over the near term at least. And I think that sense, the near term resistance for the stock is around the 790 to 810 resistance band. In the last 5-6 months, I think from April somewhere, is where the stock had taken resistance twice, and those were major rallies for the stock. For the stock to break past about those levels, it became a lot of difficulty because the stock made a lot of resistances. So I think on the way up, I would expect the stock to head to this kind of a congestion zone yet again. Whether it breaks out or not is very difficult to anticipate as of now. But I think from a short-term trading play, if someone is looking at a buy, then I think 790 to 810 could be a target range.
Fundamental experts have said that perhaps, housing and housing ancillaries are the ones which one needs to look at. And, paints as a segment is propping up. From the start of the year, I think we've been debating whether this is going to be the year where Asian paints is going to bottom out. Does it seem like that be the case?
So it's still not, the signs are still not visible, Aisha, because, the price has come back to an attractive level. But, you generally see demand coming into the stock price. That happens either in terms of volumes or speculative positions in terms of open interest. But those trends are still not visible for Asian Paints, at least on the short-term charts. I also look at it this way, that in times when the markets become volatile, there are certain stocks which generally diverge from the market and they become a lot more resilient and they stop falling. But I think Asian Paints, even in the recent last leg of the market trend on the downside, you saw Asian Paints, I think, correcting from 2550, 2600 thereabouts towards 2300 mark. So it was a very swift 10% kind of a correction for a stock like Asian Paints, even in this last or a recent sell-off. So which means that not yet the stock prices are indicative that there's any kind of a major anticipation of a trend reversal on the upside. Now there could be crude factor, etc., which could be playing out for the stock one-off. But then for big trends to play out, you need either of the setup that you need to see volumes moving up higher, stocks being resilient to a current market trend. As of now, none of the setups seem being visible for Asian Paints and even for Bajaj Paints to a larger extent.
What about real estate, Kunal? Some big movers there in trade today, looking very interesting.
Yeah, I think this space is now buzzing very strongly. So I think Prestige was one of the stocks we discussed a few days back.
Yes.
That stock has confirmed a second level of a breakout. That's aided the move for the other real estate stocks. We've seen DLF moving up higher from a base of 720 to now 740 plus levels. Godrej Properties has confirmed a break again above the 2000 mark. And I think even Macrotech Developers, which was a huge underperformer, and I think one of the stocks which is consistently making new lows, even that stock has shown signs of some bullish candlestick formations over the last 1 or 2 days. So this indicates that we could now be looking at maybe a potential short covering move or at least a further up move for the real estate stocks, at least few of them selectively. I will be bullish on the likes of Prestige at current levels, and I think after this up move just around the 1690 1700 mark where it's trading right now, we could be looking at a trading pop of another 4-5% from current levels. DLF could be a good trading bet, and especially I think from a medium term time frame, I would look at closer to 800 to 850 as a potential target range.
So, Kunal, are you saying that actually Lodha is the weakest of the lot?
Yes.
Within the realty pack?
Price-wise, it's the weakest of the lot.
And quite unlikely, right? Because I think the realty rally, the last time it happened, was actually led by Lodha.
Yeah, it was led by Lodha to a larger extent, even though I think that time the price history was limited because the stock had recently listed, I think a few years back. But even in that phase, the stock had done reasonably well. But the last 6 months, it just diverged itself from the entire sector and just went into a correction non-stop.
What about an HDFC AMC? That one's perked up 3% post the numbers. Again, the stock move has been phenomenal. It's given very good returns even in the medium term. What next for it? Because now multiples, at least on the fundamental side, have started to creep up. How's the chart looking?
You know, we generally don't discuss the AMC stocks in the same breath on how the performance has been. You look at Aditya Birla Sun Life AMC, Nippon Asset Life, I think UTI AMC, HDFC AMC. I think these stocks have done phenomenally well. You know, the best part about the charts for HDFC AMC or such other AMC stocks is the consistency of price trend. You know, the fact that these stocks, they become less volatile in market trends and suddenly they start to participate when the market gets into a sentimental or a psychological breakout, like case in point over the last couple of days where you've seen the index recovering. So I think in that aspect, I strongly believe that AMC stocks are the ones which tend to do very well in various phases of the markets. For HDFC AMC, I think after this kind of a price move, we could be looking at the stock retesting the previous resistances or the previous highs. 5,900, 990, 995 is the previous high for HDFC AMC. I think those levels should be tested. And as I said, that even Nippon Asset Life, that's another name to look out for. The stock, again, breaking past about the resistances or the hurdles just around the 900 levels. I think that should also be good to go for a 930 to 940 over the near term.
Okay, that's that on some of those, equity market plays, which are looking very, very smart indeed. But yeah, we're counting down to the market close, and it's finally been a great day. I mean, we've been stuck in a range for so long, and finally today seems like a bit of a decisive move. 182 points higher for the Nifty spot, 220 points higher for the Nifty futures, and a good comeback by most sectors, much unlike what you've been grappling with the past couple of trading sessions. More importantly, the market breadth has sprung up, and that's giving you a comfort feeling out there. Persistent, Prestige, AU Bank, Nestle, ICICI Lombard, these are all names which are holding out very well. Even movers from yesterday are seeing a follow through. Look at a 361, for instance. That stock is higher by 3.5% as we speak, and this was a big mover yesterday as well. Other than that, of course, there are other names which are also active, but on the downside, Tata Motors, Policy Bazaar, Delivery, ICICI Pru Life, for that matter, even IEX, which is closed in flat, but has seen an OI addition of about almost 12%. But let me hand it over to Snehi. We will do that in just a second. Also looking at some of the other participants today. Metals, of course, we were chatting about that. Look at a Tata Steel that's moved up a solid 2% in trade. BEL has been very, very strong. And then Trent as well, after being so thrashed out the last fortnight or so, that's made a comeback of about almost 1%, actually post its quarterly updates. And then M&M, SBI, Unilever, etc., they also continue to look very good. Kunal, we've been talking about the defense pack. Other than BEL, which has been one of the standard performers this year, where else are you seeing a meaningful move? Would you say if you had to pick out just maybe 2 or 3 names from the entire defense umbrella, including aerospace, including shipbuilding stocks, what would the selection be like?
See, I think if I have to take a high-risk bet at current levels, I would look at the shipbuilder names because I think these are the stocks which have done historically very well in phases. So I think something like Mascot Dog, for example, that's a stock which has high potential. And I think at current levels also the stock is trading closer to its multi-week lows, or maybe off by those multi-week lows by a matter of 5-10%. But then when you look at this from the 2024 highs, these stocks are still down 25 to 30%. Same is the case with other names like Cochin Shipyard and GRSE, etc., where these stocks had gone through a 50% plus kind of a correction from the 2024 highs. So as a high risk play, I think it makes a lot of sense to now look at these stocks, because whenever the cycle goes into a turnaround, the beta nature will come back again for these stock prices. And once the beta nature comes back, it's a matter of time that these stocks comes into those strong sectoral and the price action moves zones. So I think in that aspect, I would believe Mascot Doc, maybe GRSC, these could be other preferred bets. I'd also highlighted few names like BDL, Bharat Dynamics and BEML. I think these are the other names which also are inherently very strong. They've been more resilient in various of the market phases, even in the last 12 to 18 months, at a point when the defense stocks were going through a massive correction. So I think those are the other group of stocks which I'll keep an eye on.
Well, there are some others as well. Welspun Enterprises up 6.8 odd % on the back of a fundraise, 1,000 crore fundraise that's been approved. Kunal, very, very quickly, 1 minute answer. If you can give us a perspective on an Eternal stock perked at its 52-week high at this point, doing fairly well for itself, 2% higher, now a Nifty 50 company as well. What next for this one?
In 2023-24, it ended an 18-month or a 17-month consistent price uptrend. Right now, it's almost like the 7th or the 8th consecutive month of price uptrend for Eternal. So that itself should indicate that how strong the trend has been right from 2023-24. And it still looks like that the stock is good to go for a decent uptrend. Now, in these kind of scenarios, very difficult to say how much can the stock go up higher, because these are blue sky territories for the stock price. But it's just that with the subtlety of the uptrend, and the consistency it's shown over the last 8-9 months also, I believe that there is higher room for the stock to move up higher.
Okay. And it gave you such a good opportunity when it was just consolidating in that 300, 320 band for such a long time.
Yes.
And what about All Cargo? That one's up 13% today. Trying to figure out as to whether you're seeing something here, Kunal.
Nothing major, because the stock is still trading at its major multi-year lows. I think it's come back to 2021-22 lows for All Cargo, and compared to the all-time highs of 97, 98, it's just 1/3 of that stock price. So we'll just look at maybe some follow-through up moves to really determine whether the stock has formed a bottom or not.
Okay, so that's that. We let you go, Kunal. Thank you so much for joining us. But we're a couple of minutes from close, 0.7% higher on the Nifty 50. It's a decent move, 200 points higher, 25,300 plus is where we're closing in at. The Nifty Bank fully supportive, the Nifty IT also fully supportive. Both of those indices closing in well above the 0.5% mark, or rather just around the 0.5% mark, above where they closed yesterday. So those also moving up quite well. A persistent, the top gainer on the Nifty IT index. Wonder where that one is closing in at. But the sense is 7%-ish is the kind of number that we're seeing in terms of how persistent has moved today. Brilliant move by a persistent. Now let's talk about the banks as well, and so the breadth on the Nifty 50 index largely led by the banks, around 0.25% higher on an HDFC Bank that I can see, 0.5% up on the Nifty banking index. So a decently good move for the index today. Now let me talk a little bit about the breadth as well. Around 38 advances to 12 declines on the Nifty 50. Some of the losers, an Infosys, a Bajaj Auto down 1% each, and a Tata Motors, another percent odd shaved off that adjusted PV listed business of Tata Motors as it stands today. Now let's look at some of the top gainers, and within that the PSU banking index up 1.7%. Very, very strong move on the PSU banking index. Some of the big gainers there, Bank of Maharashtra, an IOB, a Punjab and Sindh Bank, a Central Bank, a UCO Bank. So it's some of the smaller PSU banks which are leading the charge, at least in trade today. Within the broader markets as well, you've seen a very, very decent move both on the Nifty mid-cap as well as small-cap indices. 1% higher on the Nifty mid-cap, around 0.8% higher on the Nifty small-cap. So decent moves on both of those as well. Also talking about the broader markets, the Nifty Realty made a stellar move. 3% higher on the Nifty Realty. Prestige Estates, the big mover on that one, 5%. Shobha also up nearly 5%. Signature up 4.5+%. Brigade also 4% up. And so was Godrej Properties, 3.5+% higher on a Godrej Properties as well. So you've got some very, very interesting moves even within the broader markets. And with that, frankly, out of time on this edition of Closing Trades. From Aisha, myself, everyone who puts this show together, thanks so much for watching. Stay with us here on ET Now. More action on the other side.